Well, not so mind-boggling are the share market returns delivered by the funds management industry. Bill McNabb is the US CEO of one of the world's biggest fund managers, Vanguard. Outside the US, Australia is the company's most important market, and he's well aware the financial planning industry needs repair. Bill McNabb, good to have you on Lateline Business.
It's a pleasure to be here. Thank you for having me.
Well, we know the funds management and financial planning industry needs to rebuild trust with investors, but how do they do that?
Well, I think a lot of that falls, frankly, to us as providers. And, at Vanguard, at least, one of our big messages is to restore trust. There really are three key components. First, and probably obvious, but you have to have complete candor in everything you do. And that's, telling it like it is. At all times, even when times are tough. The second key pillar in terms of restoring trust is simplicity. And I got a great newsletter at the end of 2008 from one of our premier investment consulting firms, and they call the 5-minute test. And it's if you don't understand an investment thesis within 5 minutes, you should take a pass. And then the third pillar in terms of restoring trust is improving transparency. In the States, we've had a big movement toward improved disclosure in everything we do and making sure that people can actually see what they're investing in. As I understand the Australian markets, there's been also a parallel move toward better transparency. I think investors really deserve that.
Well, Australia's your number one market outside the US. I presume that's because of all that money that's available due to compulsory superannuation.
Superannuation, today with a compulsory 9%, and I believe the debate is whether to go to 12, is right on the leading edge of, what we hear as we travel around the world. I happen to be, just to put it out there, a big fan of savings rates getting to at least 12%. In the U.S., we are telling our investors on a regular basis that 9 to 12 may have made sense at one point in time, but they should be thinking more along the lines of 12 to 15 in the long run in terms of setting aside adequate retirement.
To take the cynical approach, you'd be talking your book there, wouldn't you?
Yeah, I mean, that's certainly a fair question. And again, I'm going to use a U.S. example of this, but if we saw an increase in contribution rates of our 401k clients from 9 to 12, that would mean an additional, $1.5 to $2 billion of new investments based on our existing client base would flow into Vanguard funds. That's a substantial amount. We'd be very grateful for that. But this year, we will probably see about $100 billion of new cash flow come into the company, and it's mostly market share gain over some of our competitors and so forth. So from my perspective, there is a commercial advantage to those rates going up a little bit, but it's not going to make or break us as an organization. I think just from a policy standpoint, getting savings rates higher is going to be a very powerful thing. You've experienced in Australia, in a sense, a lot less tumultuousness than we have in the States, coming out of the great financial crisis. If you look at long-term equity returns in America right now, over the last decade, they're essentially zero. Bond returns have actually, been, much more positive. But the average, 401k investor over the last decade in the U.S. has probably made 4 to 5% a year. If you're in a sort of single-digit kind of return environment going forward, savings rates are the only thing that are going to move the dial in terms of retirement adequacy.
Well, the markets have welcomed the latest round of quantitative easing, but is the positive sentiment going to be short-lived?
Yeah, so, the quantitative easing, I'm not sure the markets have embraced quantitative easing. They certainly embraced the change in the Congress and having the House go to the Republican Party, and that was not a result of Republicans being more popular than Democrats. I think it was much more a drive toward having the checks and balance in place, of having both parties involved in a major way in the country's government. On the quantitative easing front, we're in uncharted territory. And, I do worry about the amount of money flooding into the U.S. system because of the quantitative easing, because anytime you artificially change the nature of, interest rates, you don't really know what the ultimate unforeseen consequences are going to be. So while it's a positive in terms of trying to stimulate the economy, perhaps, it's keeping rates so low that a lot of people who are on fixed incomes in retirement are seeing their returns eroded pretty dramatically. You think about somebody who had a lot of money in a money market fund. Our money market funds essentially yield zero today.
Bill McNabb, thanks for joining us.
Appreciate it. Thank you very much for having me.